All right, let's dive deep into one of the most talked about, most complex real estate markets on the entire planet, California. After the wild highs and a pretty confusing cool down, the one question on everyone's mind is, what's next? Well, today, we're going to cut through all that noise, get past the headlines, and give you a straight-up, data-driven forecast for 2026. So what's the deal with the California dream? Is homeownership on ice, or is it about to make a comeback? 2025 was a real puzzle, wasn't it? The headlines were all over the place. One day the market's crashing, the next it's recovering. It left a lot of you, whether you're looking to buy or sell, just kind of stuck. Well, the waiting is over. In this explainer, we are going to break down the official numbers, understand the powerful forces pulling the strings, and lay out exactly what the experts see coming down the pike. Before we jump in, don't forget to like, share, and subscribe, and check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Okay, so here's our roadmap. We've laid this all out so you get the full picture. First, we've got to set our baseline, so we'll look back at 2025, what we're calling the year of normalization. Then we'll pop the hood and unpack the big economic forces that made the market what it was. That's the why behind it all. After that, we get to the main event, the detailed 2026 forecast. And just as important, we'll talk about the risks that could change things, because hey, nothing's a sure thing. Finally, we'll turn all this data into a playbook for you, whether you're a buyer, seller, or investor. Then we'll wrap it all up with a final summary. So let's start by rewinding the tape. 2025 wasn't the big crash a lot of people were afraid of, but it wasn't a boom either. Really, the best way to describe it is a normalization. Think of it like the market just needed to catch its breath after the absolute insanity of the early 2020s. The brakes got slammed, for sure, but the car didn't crash. It just slowed way down. Let's get into the hard numbers. Statewide, home sales for 2025 ended up right around 269,000. Now, to give you some perspective, during the boom years, we were seeing well over 400,000 sales. So, yeah, that's a major slowdown. Early in 2025, there was some talk of a recovery picking up steam, but it just didn't happen. The market pretty much just flew sideways all year, holding steady at a low altitude instead of climbing.
And what about prices? This is where the story gets really interesting. After years of absolutely mind-bending double-digit growth, the year-over-year price increase for 2025 was just 1%. Seriously, 1%. The initial forecast at the start of the year was for a much healthier 4.6% gain. The reality showed us a market with way less gas in the tank, signaling a major cooling of that buyer frenzy.
So this brings us to the new reality, the new baseline for California real estate. By the end of 2025, the statewide median home price was sitting around $874,000. And just to put that in perspective, the median for the entire U.S. at that time was around $400,000. So even in a cool market, California real estate is still more than double the national median. That price point proved to be incredibly tough, and it just goes to show how strong the underlying demand really is in the state.
But California isn't just one big market, right? The story was different depending on where you were. In the Bay Area, for instance, it was complicated. A nice single-family home in a good spot held its value, but the condo market actually saw a bit of a dip. Down in LA, prices were mostly flat, but inventory started to creep up, which gave buyers a little more breathing room, a little more power to negotiate. And a huge trend we saw was more and more interest in those emerging suburbs as people got pushed further out looking for something they could actually afford.
So if you had to boil down 2025 into one key takeaway, it's this. It was the year things got back to a sense of balance. The crazy bidding wars, they pretty much disappeared. Instead, we got a more traditional, more negotiable market with really modest growth and flat sales. And honestly, for a lot of people worn out by the chaos, that stabilization was probably a welcome change.
Okay, so knowing what happened in 2025 is one thing, but understanding why it happened, that's the key to figuring out where we're going next. So let's move from the what to the why. We're going to look at the three big economic forces that really dictated how things played out.
Look, if 2025 was a movie, mortgage rates would be the main character, or maybe the villain. It was, without a doubt, the number one driver. After those crazy, once-in-a-lifetime low rates of the early 2020s, we spent most of 2025 with rates hovering over 6%, averaging around 6.6 for the year. And that one factor just crushed buyer purchasing power. In a place like California, a 1% rate hike can add hundreds, sometimes over $1,000 to your monthly payment. That alone takes a huge chunk of buyers right out of the game.
Now, this leads to a super important idea you have to get to understand today's market, the lock-in effect.
See, high rates didn't just sideline buyers, they kind of paralyzed sellers too. Think about it. Millions of Californians are sitting on these incredible mortgage rates, like 3%, maybe even less. So why on earth would they sell their home, give up that amazing rate, just to buy a new place and get a new loan at over 6%? The simple answer is most of them wouldn't, not unless they absolutely had to. And that kept a ton of homes off the market, which kept supply tight and put a floor under prices, preventing them from falling off a cliff.
And hey, don't just take my word for it. This became a huge national story. This headline from the Wall Street Journal says it all. Mortgage rates are falling, but owners still won't sell. It's powerful because it's true. Even when rates eased up a tiny bit during the year, that lock-in effect was just too strong. Homeowners stayed put, inventory stayed low, and the market was basically stuck in a stalemate. So, what happens when you combine historically high prices with much higher mortgage rates? You get this, a massive affordability crunch. I mean, this chart is stark. In 2025, only 17%, less than 1 out of every 5 households in California could actually afford to buy a median-priced home. Let that sink in for a second. That means 83% of people were just priced out. That's not just a number. It's a huge barrier that defines the entire market. It puts a hard cap on demand because there's just a limited pool of buyers who can make the numbers work.
So to wrap up this section, the story of 2025 was really written by these 3 powerful forces working together. You had high mortgage rates that hammered what buyers could afford. That created the lock-in effect, which choked off the supply of homes for sale. And the combination of those 2 things gave us historically low affordability, which kept most would-be buyers on the sideline.
Okay, so we have a really solid grip on the past. We've set the stage. Now let's turn our attention to the future. This is what you're here for. The official, data-driven forecast for the California real estate market in 2026. What do the experts see coming? Let's find out.
So, here's the big question. What is the California Association of Realtors, or CAR as they're known, what are they actually projecting for 2026? Their annual forecast is one of the most respected reports in the business, built on a ton of data. So let's break it down, number by number. And hey, since we're right at the midpoint and about to dig into the heart of the forecast, this is a great time for a quick reminder. If you're getting value out of this, don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide.
Okay, this right here is the hero slide of the whole presentation. Let's really spend some time with it because every number tells a piece of the story. First, let's look at sales volume. CAR is forecasting a modest 2% bump in sales, up to about 274,400. Now, that's not a boom, but it's a really important turn in the right direction, suggesting we're finally getting off the bottom. Next, the median price. It's projected to climb by 3.6% to a new record high of $905,000. Again, we're talking moderate, sustainable growth, not some crazy spike. Now look at the engine driving all this, mortgage rates. The forecast is for an average rate around 6%, which is a big welcome drop from the 6.6% in 2025. That's the key that can unlock some of that pent-up demand. And finally, you see it all come together in the affordability index. It's expected to tick up just 1 point to 18%. It's a small step for sure, but it's a step in the right direction.
So let's put it side by side. This really helps visualize the shift we're talking about. Think of it as moving from a frozen market to a slow thaw. We're going from the reality of 2025, flat sales, tiny price growth, and really tough affordability, to a forecast for 2026 that shows a modest rebound in sales, moderate and healthier price growth, and a slight but psychologically important improvement in affordability. The key word for 2026 is modest. The market isn't expected to just snap back, it's expected to slowly and carefully start to heal.
So if you're looking for just one sentence to sum up what the experts are thinking for 2026, this is it. The forecast points straight towards stabilization and modest, moderate growth. It is definitely not predicting a big crash, and it's not predicting another super hot boom. It's all about a gradual return to a more functional, more balanced housing market, even if it is still a very expensive one.
Now, a forecast is not a crystal ball, right? It's an educated guess based on the best data we have right now, but it is not a guarantee. So to be responsible, we have to talk about the risks, the potential headwinds that could blow this whole forecast off course.
Let's break these risks down. First, and biggest, is interest rate volatility. The whole forecast really depends on rates easing down to that 6% range. If inflation sticks around longer than expected and the Fed has to keep things tight, rates could stay high. That would definitely put a damper on the recovery. Second, the growing crisis around insurance and construction costs. This is a huge deal in California. In areas with high fire risk, just getting affordable insurance is becoming a nightmare, which directly hits a property's value. Third, the overall economy. If job growth slows down, especially in the tech sector, that will ripple through the housing market. And finally, you can't forget regional differences. The expensive coastal areas might hold steady because there's just no supply, while some inland markets could soften up a bit.
All right, we've gone through the data, we've analyzed the drivers, and we've talked about the risks. Now let's make this practical. How do you take all this information and turn it into a smart strategy for yourself? This section is your personal playbook, with real advice whether you're looking to buy, sell, or invest in 2026. Okay, for all you potential buyers out there, listen up. Here's your game plan. Step 1, expect to have more leverage. As inventory creeps up a bit and homes sit on the market a little longer, you'll have more choices and more room to negotiate than you've had in years. Step 2, get ready for more competition. As rates come down, all those buyers who are on the sidelines are going to jump back in. So it'll get busier, but it shouldn't be a frenzy. And step 3, and this is crucial, be ready to make a move but manage your expectations. This is not a market where you should be waiting for big price drops. The forecast is for modest growth, so waiting for a crash that probably isn't coming is a good way to get left behind.
Now for the sellers. The world is different, so your strategy has to be different too. Step 1, you have got to price your home correctly right from the start. The market of 2021, where you could just throw out a number and get a bidding war, that's over. Work with your agent, look at the recent comps. Step 2, be patient. Expect your home to be on the market longer. It probably won't sell in a single weekend. And step 3, understand that getting that top-of-the-market premium price is now reserved for the best of the best homes in the most desirable neighborhoods. For everyone else, being realistic is what's going to get your home sold.
And what about investors and developers? There are definitely new opportunities popping up in this changing market. For investors, the best deals might not be in those super expensive coastal cities anymore. You might want to look at secondary markets like Sacramento or parts of the Inland Empire, places with good job growth and more reasonable prices. And for developers, the mission is crystal clear: focus on affordability. The demand for entry-level housing is massive. Things like modular construction, ADUs, anything that helps solve that critical supply shortage at a lower price point is going to be a big winner. Wow, we have covered a ton of ground. So now it's time to zoom out one last time and put all these pieces together. Let's look at the big picture and talk about what this whole journey, from the normalization of 2025 to the rebound of 2026, really means for California.
You know, this simple timeline really tells the whole story. After that inevitable cool down from the peak, we entered what we've called the Great Normalization in 2025. That was the year of rebalancing, where the market finally caught its breath. And now, the forecast is pointing us toward 2026, a year of a modest but important rebound, as the market slowly starts to heal and find its footing again.
If you remember just one thing from this entire explainer, please make it this. The California real estate market is in transition. It is moving away from the gridlock of 2025 and into a modest recovery. And what that does is create a much more balanced, much healthier dynamic for both buyers and sellers. It's becoming a market where deals can actually get done without all the stress and chaos of the last few years.
And so I'll leave you with this question. We've given you the data, we've shown you the trends, we've laid out the strategies. We know a more balanced market is coming. So the question is, how will you adapt? Whether you're a first-time buyer, a current homeowner thinking about a move, or an investor looking for that next opportunity, the game is changing and your strategy needs to change with it. Before we go, one last time, we hope you found this deep dive valuable. Don't forget to like, share, and subscribe. And check out the links in the description if you're looking for a real estate agent in your market or you need life insurance. My team and I can help you anywhere nationwide. Thanks for watching.